gold doesn't change in value or price. The beauty about gold as a safe haven asset is that it has proven year after year, decade after decade, in some degree, century after century, to have relatively stable buying power. My current forecast is anticipating that gold will hit this calendar year. That is my current prediction and where I think gold will inevitably show up.
Hello and welcome back to Soar Financially, a channel where we discuss the macro to understand the micro. My name is Kai Hoffmann. I'm the @JR Mining guy over on X, and of course, your host of this channel. And I'm looking forward to welcoming back Gary Wagner. He's the head and brains behind the goldforecast.com and a phenomenal guy to chat with. Really looking forward to the next 30-40 minutes here with him. He's a friend of the podcast. We've had him on numerous times and for good reason. He's been absolutely spot on with his gold calls on our show, and who better to ask about whether we're overbought in an overbought scenario and where's everything headed? Are we going to see 3,500, 3,600, even 4,000 like Jeffrey Gundlach predicted here? We'll talk to the real pro here. We'll talk to the guy who's been nailing his calls. And before I switch over to my guest, hit that like and subscribe button. Helps us out tremendously bringing guests like Gary on the show, and we just appreciate it. It's a free way to support us. Thank you so much for that. Gary, welcome back on the program. Aloha.
Thanks so much for having me. I mean, living in Hawaii, I will always work with someone named Kai. Kai means sea, of course, in here. But it's always a pleasure to talk to you. We've been doing this for a while, and you've got such a great audience that's hungry for this information. So I hope that in the little bit of time that we have today, we can share some actionable information that allows them to be more aware of how to work with the precious metals and hopefully make them a little money to boot. Can't guarantee that, but that is the goal here.
Oh, fantastic. Who doesn't like making money, right? And at least get educated to have a basis. That's the whole point. That's what we're trying to do. And Gary, we couldn't speak at a better day. Again, another historic day in gold. We've hit another all-time high in the spot market, 30.59. You'll correct me. That's the number I have in my head. But phenomenal action in the gold price that we're seeing, and we'll have to get to the root of it. We spoke December 22nd, roughly, last time. Before we get into the today and the now and the future, let's talk about the last 3 months. What took us to where we're at today?
Multiple factors, obviously. We still have the geopolitical conflicts, Ukraine, Russia, as well as the Middle East. Those are absolutely unresolved. We have the issues that we have had prior to January 20th. And that was kind of the turning point also, because we had a new administration, not new, he's done this before. So we had some idea of what to expect, but President Trump has done a lot for us gold bugs. Absolutely. He has, in that way, he has been our friend. And so a lot of it has to do with kind of the intrinsic uncertainty factor that he brings. While many of the steps that he's taken are not only warranted, but I believe will lead to some good, others not so much. The bottom line is he's not only controversial, he does things because he believes that they'll serve his end goals, but at the same time, they are serving the precious metals market, specifically gold. So I can't fault someone who's set up a series of administrative and executive orders that has moved gold phenomenally higher. This for a while. I remember to the day what it was like in 2009 and 10, that run up to the middle of 2011 when we touched $1,900 an hour. My God. Truth be told, at 1,900, I was sure it was going to 2,000. Doubled down on my positions and kind of got hurt. But that's the reality of a trader. That's how we learn these things. On this particular run, I have been fortunate enough that I could even try something a little bit more aggressive and get away with it because gold continues to run. So right now, what we're dealing with is the real and genuine concern, and this is not out of my mouth, but I definitely agree with this, that these tariffs could bring, most importantly, they're really going to affect dramatically pricing. Pricing not only for what Americans pay and Canadians pay, but for what global citizens pay. Because from what he says, and the one thing that we've learned about Trump is he typically moves forward with the ideas that he presents. He's saying he wants to include the European Union. What I find most interesting is that he doesn't differentiate between allies and those that we might be politically on the other side of the fence, like Russia or China. He taxes them all. Okay. He has no prejudice in terms of who he wants to impose these tariffs on. And so the fact of the matter is, we're supposed to word it, it could lead to higher prices and therefore genuinely result in an uptick in inflation. I'm going to step out by saying, in my opinion, first, of course, there's going to be higher prices, and that those prices will lead to dramatically higher inflation over time, depending on how long he continues with this program of taxing imported goods into the U.S., because the countries he is imposing this levy tax on are reciprocally doing the same back. So whether you're living in Europe or in the United States or in Canada or in Mexico, there's in fact not that many places that are sheltered from the basic fallout that could happen from this. But it most likely will do two things. Higher prices will lead to inflation. And that will cause a huge contraction in the global economy. Simply put, if goods, not services, but if goods are costing more, the net result is going to be that people don't buy as much, that the economy suffers from it. And so those are two cornerstones that churn GDPs globally. It's what this entire world is built on of marketing, of selling products, of being where we're at, is the fact that we have international trade. No matter where you produce it, you can pretty much sell it anywhere. And if it's a quality product, there's a market for it. So he's changing that up. And in that way, I think we're going to have a very large impact over time. Now, what that impact will be, there's been numbers thrown out. But when you have Fed members and Chairman Powell, and I'm addressing the last FOMC meeting, coming out and basically stating that let me tone down the language, but the unknown actions that it'll have, I think they called it erratic, but the fact that no one's ever sure as to how he's going to pivot, where and why, it keeps people on their toes, and it is most certainly going to have a dramatic and profound impact on the global economy. And that is going to create hardship for working people, the middle class, even those that are upper middle class. And really the only ones that will be able to avoid, the repercussions are the ultra wealthy, because they're not so concerned if a loaf of bread is $5 or $10. If a gallon of milk is $3, $5, or $10, it doesn't affect their day-to-day lifestyle. But that is the 1%, so to speak. So this is going to be felt globally. And I believe the fallout, although we don't know how severe it will be, there will be fallout. And that fallout will be, for the most part, detrimental to the millions of global citizens making a decent living, but finding that their fixed income just doesn't go as far anymore. And so, though, that really, to me, is the crux of what we're witnessing now. And it's been a large component of moving gold higher.
Yeah, no, very, very comprehensive here, Gary. I've taken a lot of notes on what you just said. Just also a couple follow-ups as well. Since you're a technical analyst, of course, I might maybe start with asking you about the rotation into gold, the capital flows into gold. What are you seeing here? Where is the money coming from that has been driving gold higher?
Any investor that has a respectable portfolio that's really important to them, whether it's retirement, whether they're at a point where they're living off of that income, is very sensitive to risks as well as potential rewards. And so US equities have come under pressure. Global equities have come under pressure. And so self-directed investors, because the ones that have their money being managed, this is happening for them on their behalf anyways, realize that they need to redistribute, to reallocate parts of their portfolio to address the possible scenarios that could unfold because of this, and protect themselves and protect their hard-earned dollars. And so they're going to look at safe haven assets. Now, it used to be that really the two top, the kind of the gold standard, and I didn't mean that as a pun. I kind of do, because it used to be the dollar and gold, not so much the dollar anymore. But gold has always been the gold standard. And the amazing thing about gold, and I've said this at multiple lectures I've given, and I've said this over the last 30 years of speaking, is that gold doesn't change in value or price. The beauty about gold as a safe haven asset is that it has proven year after year, decade after decade, in some degree, century after century, to have relatively stable buying power. And I remember I used to do a lecture where I tried to illustrate that point. And I would reach in my pocket and I would pull out a $20 bill in one hand and a gold coin that said value $20 in the other hand. And I said, if you go back to like the, 1910, 1930, you could take either means of payment and spend a weekend at the Plaza Hotel in New York, because I think that at that point, that was around $7 to $8 a night, not for a suite, but just for a room. Steak dinner, about $1.50. Haircut, easy. A nice suit, wasn't that much money, $7 to $10. And you could pay for it with the $20 bill or the gold coin at 1 ounce, 999, that said $20 on it, because the government was guaranteeing performance on gold for $20. Now, take this forward any amount of years that's reasonable. Take it forward 10, 15, 50 years. Take it forward to now, it's ridiculous. But if you've got a $20 bill now and a $20 gold piece now, I'm not sure what the Plaza is, but I know that the 4-star hotels out here are about $500 a night. I'm assuming Plaza is probably a little bit more or in line with that. if you want to buy just a decent off the rack suit, I'm not talking about custom silk, tailor made. It's still going to run you between $800 and $1,200. A steak dinner certainly going to cost you $100, $200. And so if you try to pay for a weekend at the plaza, a suit, just enjoying yourself for the weekend in New York, you can certainly pay for it with that $20 gold piece because you convert it. It's worth about $3,000 and you can accomplish the task. In other words, what gold was able to buy in 1910 or 1915, it's still able to buy today. So the raw reality of gold is that gold doesn't really appreciate in the way that we traditionally think. It's not like a home that's worth more. It's always had a very stable buying power that has transcended time itself. And it still allows you to buy pretty much the same material goods that you could, 100 or 200 years ago. Now, what are you going to get with the $20 bill? I don't have to tell you. If your friend chips in, you can get maybe a fast food meal and share a cup of coffee, but that's about it. So when you think about what these two mediums had in terms of buying power, gold has held up exceptionally well, whereas fiat currencies are doing well. You know what they're doing. There is no real buying power over time with stability. And so that has been the earmark of what gold does in terms of just seeing it as a viable tool to barter and buy goods and services with, is the fact that it's had that a very strong buying power that stayed relatively close over long periods of time. Whereas with fiat currencies, obviously, the one thing that is a absolute truth is the dollar will buy you less this year than it did last year. It'll buy you a lot less than it did 10 years ago. You can keep going back and you'll never have a time where the dollar bought more this year than it did historically speaking. And we all know why that is. It's fiat. The definition of fiat is, yes, it is backed by the faith of the government that produces it. And they are true to their word in that if you have currency, US currency, euro dollars, any of the, call it the big five, the big three, whatever it is, you can transact business and it has value. And that value has maintained itself, although it buys you less and less over time, but it's still widely accepted as a form of payment to eat, to live, to do these other things. And that, to me, that's the key. That's what you want to take away from your understanding of what benefits gold has, because if you extrapolate from that basic concept, you can draw a really easy inference, and that is gold will always have value, intrinsic value. That intrinsic value won't change that much, but compared to a piece of paper that's an IOU, there is no exception. There is no instance where I've seen currencies begin to outperform a precious metal or a real asset. And I don't see how that could change unless a country was able to go on the gold standard, which is impossible, so a modified gold standard. And even that would have challenges, because who can afford to back their currencies with a hard asset that's would take billions upon billions of dollars, but not fiat dollars, but billions and billions. It's difficult, if at all possible, to do. And until that happens, gold will also always be the premium method of storing wealth or a safe haven asset.
Oh, absolutely. And let me try bridge the Let me bridge it over to today. Let's find a segue here. And it's really, has gold now caught up or closed the value gap perhaps to the US dollar and the diminishing US dollars, if that makes sense? Like the move we've seen in gold versus the devaluation of the dollar. And gold, as we speak, is trading around. Let me actually get a current price here.
I'm looking
30.56. So
okay, and I'm looking at 30.68 April futures, which will roll over today. So, well,
but you get my question, right? Has gold caught up to that
absolutely.
value? Yeah, okay.
Can it ever? And if it could, how would it accomplish that? The answer is, quite frankly, no. There are certain currencies that are widely accepted almost anywhere in the world, like the US dollar, like the euro dollar, as a means of moving wealth to transact business. All right. That will always be the case. But the key is this: why does the dollar have greater or lesser buying power? And it has to do with what's backing that dollar. And so there's this little kind of dirty 2-letter word that people don't like to use. So I'll say it quietly. It's called fiscal debt. And as long as fiscal debt isn't being properly dealt with, there is only one way that the value of the dollar relative to buying power, I don't mean the value of the dollar relative to other currencies, because not all, but I'd be hard pressed to find an exception where a country is not accumulating more debt. Switzerland is probably the only example, but they've been that way. They've marched to a different drummer for years. And kudos to them. But as long as we print money, and the money that we print is based upon our store of wealth, what assets that country has, and as long as those assets tend to diminish over time, you can never get a point in time in which the dollar will play catch up, so to speak. It can't. I mean, it can, but to do so would take some exceedingly hard steps that I doubt that any government or any group of consumers are prepared to pay the price. Because what's the price that you pay for it? You would pay with a lot of financial pain over a period of time as the currency equalized, because you slowly took debt out of the country. And yes, that would make that currency more valuable in relation to other currencies that weren't doing that. But it would also cause so much hardship and pain to the citizens of the country that was trying to accomplish that goal. Whoever implemented that strategy and tried to put it into action wouldn't really be too popular.
Yeah.
And so for that reason, we have an intrinsic dilemma that I can talk about it, but who has answers for that to accomplish that goal? Because I think that most people, any sentient individual, especially those that have some idea of economic principles, it can't go on forever. I don't believe that a currency has outlasted a country in history. I think the longest a currency stayed as the apparatus by which you bartered and did business was China, and I think it was around 900 years. I could be really wrong on that. But there is no currency that didn't at some point cause a catastrophe in that government, because intrinsically the currency kept having a lower and lower buying power. Wages typically didn't keep up with it. The system from the get-go was broken.
No, makes sense. Absolutely. So maybe a bit my next question, which it takes us really to the now, is like, is gold overbought, overhyped right now? And where are we at in that scenario here, Gary? Shall we bring up the charts?
Huh?
Shall we bring
I'm
up the
sorry.
chart?
Go right ahead. I mean, if we're going to do that, let's actually take a look at this from a timeline that covers some history here. I might even go to a weekly, but if we look at gold, gold has continued to gain value. Yes, it's had ups and downs. If you think about gold when it ran up in 2010 to the middle of 2011, it started at 700, then 1,000 was a big benchmark. And then middle of 2011, it runs all the way up. And I don't know if I can go back that far without turning this into a weekly. Yeah, that will work. Yeah, it ran up phenomenally. Now, this is futures. I would have to actually adjust it so that it represented, because gold wasn't at 2,300 back in 2011, it was at 1,900. But that being said, gold went from 1,900 after running up phenomenally down to the end of 2015, the beginning of 2016, and it settled at $1,020. It roughly halved. So there is volatility. We've seen gold rise tremendously and fall tremendously. But as a whole, it's maintained value while going through times of beautiful ascent and times of a lot of pain. Now, when we look at the angle or tact in which gold rose in 2008 to 2011, it's a pretty steep angle. The decline was a multi-year decline from 2012 to 2016, 4 years. And then it became range bound between about 1,500 and 1,800. It did that for a while until it made a series of pops. But I draw your attention to what we saw recently. And I guess we'll start right here, October 23rd, 2023. Obviously, we had a scenario. This was when the Middle East war really heated up. This is when the attack took place. And we saw it run from $2,000, which already has tremendous value, but over a period of time. So if we look at October, it is sitting at $2,000. If we go to October a year later, and this is just rough, it's at 2661. So in 1 year, it didn't double, but it definitely did a huge gain. But the angle still had plenty of times of peaks and valleys. But then something strange happened. And what that was in December of 24, gold sitting around 2,600. It makes a move up to about 2,700, comes back down to 2,600. And look at the angle. Look at the slope of the rise going from 26, 3,000, and now we're above 3,000. So it's gained 50% in value. It went from 2,000 to 3,000 in a really short period of time. This is, by, at least as far as I'm concerned, by every definition of the word, and I'm trying to verify, pretty sure we're looking at a daily chart. But whether it was daily or weekly, it's still, this is basically very close to a straight parabolic move. And so what we have seen over the last 2 years, year and a half, is an acceleration of the pace in which gold has moved to higher values. Now, what would do that? First of all, with gold, it is a true safe haven asset. And as more uncertainty crops out into the economic environment globally, more and more investors traders, money managers seek the safety of a safe haven. And that's what we're seeing here. And so the fact that, you went from 26 up to 29 and then back down to 28, what has impressed me more than anything about this most recent move from December 18th to current pricing is there's really been 2 points, even though it's been not parabolic, but an exceedingly fast market. You get very, very small corrections, minute. So it tops out at 29.70 and then it moves down to 28.45. That's a fractional correction. These corrections, typically as a market technician, we consider a shallow correction to be 23%, 36%. Medium is 50%. That's not a Fibonacci number. And then 61.8% retracements are considered to be deep Fibonacci corrections. And a 78% correction is the deepest that we find basically acceptable. But it doesn't break the momentum completely. You can still go back, return to a bullish demeanor. We've seen this market rise to incredible values exceedingly quick with almost no corrections. One of the toughest things as a trader and an advisor who tries to predict where gold is going, when it's going to go there, and then make specific trade recommendations is the fact that gold has been ascending so quickly. And if you miss it, in other words, if you didn't go long at 2,600 and now it's at 27 or 2,800 2 months later, it makes it very difficult to enter the market because you look at it as, oh boy, we really missed that price, but we'll get it on a pullback. And then as you can see, you don't really get a pullback until February. So it's been extremely tricky in terms of timing. And the truth of the matter is, and not that anybody that has an ounce of sanity in them can act on easily, is that when gold is running, for example, from 26 to 2,900, you can buy at any point along this path and make money. But that sounds really easy. And in reality, it's not an easy move to do. It goes against everything. Let's wait for the pullback, and the pullbacks don't come. So when they do come, and this is what I've noticed over this last year that I've never seen with this kind of fever, is that market participants are so quick to buy the dip. You see it go down, it's there for an instant, and then it's back up. During a trading session, you have a big correction and it recovers by the time the session is closed. On one hand, it's done nothing but present opportunities. You can buy it anywhere along that. On the other hand, the opportunities are few and far between if you're trying to time it properly. And if you don't have a trading disposition that is hard as a diamond, can't be cracked by a sledgehammer. I mean, you need the fortitude of a tank to be able to do the things needed to do. And so then money managers and traders come up with elaborate game plans, whether they do covered calls, they start to hedge certain things, they work in different ways. Of course, it allows them to profit, but not maximize a profit. But at least there's a greater level of safety there. So that's what I've seen being implemented on a grandiose scale. The bottom line is, to answer your question, because I apologize, I totally went off track. Is gold overbought? It's relative. It's overbought at $3,060 if it goes back down to 28, but I think that it's more likely that it'll go to 3,200. I don't see gold as being overbought, although on a technical basis it is. If the question is, if you get in now, is it going to come down hard and have a detrimental impact on your portfolio? I would say yes, that can happen, but it's a lot less likely than so many other instances when we've seen gold run like a fever hot, running very, very quickly and gaining value in a very short period of time. Is it overbought? If we look at a stochastic oscillator, if we look at the RSI, if we look at the momentum in some momentum studies, we'll find that it goes into overbought territory and it slams, it stays in overbought territory until you get, for example, here, and then you get the move at the end of February from 29 down to 28. That is as good of a correction as we've seen recently. So there's opportunities. Is gold overbought? Well, the true answer is absolutely. I put this not in the best.
But maybe to jump in here, Gary, real quick, what you've been saying, though, it's been a healthy move, meaning the chart doesn't need to correct necessarily because there have been dip buyers, right?
I've never seen people buy the dip in the way that we have seen it. Let me... Yeah. If you can keep talking, I'm just trying to set
it's like because I keep thinking like when
so that I can kind of illustrate this point of being overbought, and it shouldn't take me too long.
No, I'm just trying to understand to see any meaningful gaps in here, but it's always like there were small corrections. It was never one of those big days where it jumped up $100 or so. That needed to be closed. So I'm curious if you've seen that, if there are any gaps in the chart that we'll have to come back to make it a productive and healthy chart.
No, there hasn't been a gap that hasn't been filled. Yeah. Stochastic oscillators, and for those that don't understand the formula, let me try to simplify the definition of what it's doing and how it's doing. It's looking at the highest high over a period of time and comparing it to highs over another period of time. So when the stochastic oscillator is over 80, that means that the high that's currently in the market is exceedingly close to the highest highs that have been around for a period of time. That's what the percent K and percent D. Percent D is an average of that, and the percent K looks at current pricing and the high and compares it to other highs over a period of time. So you can see that it overbought, and look at how hard it comes down. But in reality, gold went from 25.80 down to 24.60, not a tremendous move. So whereas it will go into overbought territory and then come down, with the exception of maybe this move that occurred the end of October 24, in which it topped out at about 90. That's a good level. And it actually moved below 20 and then crossed back over. When it crosses back over, I'm going to try to... That's right here. So it wasn't really laggy. Any of these momentum indicators intrinsically have lag because it's real-time data, and there's intrinsically a lag between the way the market moves and the way these numbers catch up. But even though it's been overbought, they've been short periods of time with relatively shallow corrections. So for that reason, is it overbought? Heck yeah, it is. And when it gets into overbought territory, if we look at the example during this run up here, it went to overbought just before the inauguration, Thursday the 17th, or Friday the 17th of January, and it stayed pegged here till February 25th. So it remained overbought, and that's just referring to this little area. It does come down, but that's short-lived. It's not a typical market where we see something go exceedingly overbought and then have a protracted period of correction, price correction. We're not getting that. So is it overbought? Yes. And that doesn't really surprise me.
No, of course. The question is now, Gary, maybe to come to a conclusion here as well as where are we going from here? What are your targets? Gary, we need to get the crystal ball out. We need to know, are we going long or short, Gary?
Well, we're picking appropriate spots to go long. I am definitely not a short player, not at these levels. I use a technique that I made public in 2010. I started learning about technical studies in 1985, all Western technical studies. I used a platform called Future Source. And in the early 90s, they started giving you the choice of a bar chart, a line chart, all the things we were familiar with, or these funny little rectangles called candlesticks. And they looked kind of cool, but I had no clue what they meant, how to interpret them, how to deal with them. And I had a client, initials DM. He wouldn't mind if I said his name, but he's an engineer in Connecticut. And this guy had a self-directed account. All I was doing was placing the trades, and he was hitting 7, 8 out of 10 trades. He had a performance record I would only dream to have seen, and I had never seen it before to that magnitude. A good trader, when I'm on my game, I'm hitting 6 or 7 correct trades out of 10, but I'm making money because I've got good risk reward in place. I've got stop placements that I trail. But when I'm at my best, I'm not doing 8, 9, or 10 out of 10 trades. No one does that. It's that we have good money management, and that we have the ability to not get overly greedy. In other words, realize, I guess Paul Volcker that said, trees don't grow to the sky. They never have, they never will. And so, in other words, there's caps to everything. And so what I have developed is, I called it a triple triad. I use candlesticks to look for patterns. There are certain patterns that we can identify at particular tops or bottoms. This, although it's hard to see it, is a dark cloud cover right here, means market's going down. This is an engulfing bullish. I combine that with Elliott Wave. I'm a huge proponent of Elliott Wave. Those that utilize it can be really, really bad or very adequate. There are not that many that have the kind of grasp that when you look at their work, it's more than kind of hocus pocus. I've studied it for years, and every day I believe I get a little bit better, and I'm almost average, let's say. But the idea with Elliott Wave is that what moves a market is psychology. People don't buy a stock because they go through the book value and they see that it is undervalued, because if you break the component, it's all psychology. It's all psychology. So when a market moves up, it's moving up for more than just the simple reason that you would think. So what Elliott Wave theory postulates is that psychology rules the thinking and market sentiment of a market. All markets move in cycles. And what he came up with was the idea that there are phases. He calls it a motive phase or a corrective phase. The full thing equals a full cycle. And so what he's saying is that if we can look at the chart, basically what he is doing is he's starting at a point and then going wave 1 right here, corrective wave 2, and there's parameters for all of this, then wave 3, wave 4, and wave 5. At the conclusion of wave 5, it has completed what's called a motive phase and will now enter a corrective phase in its simplest format will be some sort of an A, B, C correction as we get here. If the fundamentals that are moving the market are still evident, then that cycle will repeat itself. It will go again, 1 through 5, ABC, 1 through 5, ABC, until sentiment shifts. And then you go from what's called a bull count to a bear count. And I have found that if you use it alone, it's very difficult, but I combine it with pattern recognition of both Western patterns as well as Eastern Japanese candlesticks. I use Fibonacci numbers as the core to predict how high a wave 3 will go, because basically what we do is we use wave 1 as a benchmark. Wave 2 will be a correction of either shallow, so that could be as 38, it could be 26 or 38, and then wave 3, and the rule is it cannot be the shortest, will typically go as a 1.618 extension. If we measure our wave 1 here and then start our extension here, this is going to be anywhere between 1.5 and 1.618 extension. If there's a shallow correction for 2, 4 will have a deep correction. There's some rules that you follow. And so utilizing these techniques, my current forecast is anticipating that gold will hit 3,300 to 3,400 this calendar year. That is my current prediction and where I think gold will inevitably show up. And if we go back, you'll see that I've had this Elliott wave count ongoing for years. I mean, it's just something that I do. So wave 1, 2, 3, 4, 5, ABC. Again, repeats itself. 1, 2, 3, 4, 5, ABC. And we've just restarted that count. And that's where we're at now. The key right now, of course, more than anything, is my model mimics the fact that these tacks or angles continue to get stronger. In other words, price advancing over time becomes quicker, steeper, and more profound. And I think that will continue until the underlying fundamentals that have caused that change.
No, and those fundamentals are still intact. I don't think we'll get rid of any of the uncertainty anytime soon. So I think we've agreed on that in the beginning, that the theme is still intact. Gary, what a wonderful conversation. It was a true masterclass, and I really appreciate that because you gave us a bit more insights than usual on your thought process, which was really enlightening and really interesting. So I appreciate that.
Thank you.
But people can still learn a lot from you. So where do we send them to learn more?
Well, we have a YouTube channel, The Gold Forecast. We have our premium URL or website, thegoldforecast.com. Every video we have done, and I think it's up at around somewhere around 3,000 videos because I do 5 a week. I don't know why I do that many, but and those are available to watch now at no charge. You're not going to get the one I did today or yesterday. They're typically delayed by a week. Otherwise, I'd be very difficult to build a premium subscriber base that felt it was warranted to actually pay for my services if I was providing real-time calls at no charge. But we keep it very competitive. It's around $100 a month. If you sign up, you try it out. See if it's valuable to you. If it helps you be a better trader, if it helps you make money, if it helps you not lose as much, because I'm not guaranteeing to anyone that using any system is going to make money. It's much easier when you look at a gold market right now to make money, as long as you don't try to stand in front of the train track and go short, short, short. In other words, work with the trend. We keep it very reasonably priced. As long as it's giving you valuable information that's making you money, continue to use it. And I'm going to go, I haven't even asked you this before, but I'm going to go one step further because I've worked with you for a while, and I really think you have an astute following. For those that sign up and give this 12 hours, because I have to tell my IT guy that we're doing it, for anyone that goes to our site and tries this out, we will give them 30% off. So rather than $100, be like $70 forever, as long as they stay with the program, as long as they put Soar Financial in a coupon box, and give that about 8 hours or so. I got to let him know also that I've decided to do this, but luckily I own the company so I can make these rash decisions. And that way, if you're getting value from it, if it's making you a better trader, now you can do that with putting out less in your pocket. And in times like this, we want to maximize our profits. And one way is to get quality information, but make it as affordable as possible. So Soar Financial in the coupon code box, thegoldforecast.com. It's the best way to know about us.
Fantastic. Gary, phenomenal. Thank you so much for your time. It's great to have you on. We'll have to do this again soon because there's so much happening. It's tough to stay on top. We can't day trade with you because, as you said, you don't give away the secret sauce for free here, which makes sense. But we got to get you on. I don't day trade,
but I actually, even if I gave it away for free, I don't day trade. The reason being is I have patterned my trading techniques and styles off of people that I've seen have stellar performance. And day traders are able to consistently whack money, but then they can get hurt very, very easily and give a lot of it back because I shouldn't say it's easy to make money trading futures. It's near impossible to hold on to it. Risk reward. So day trading accentuates that risk to where a couple of trades where you're getting stopped out will wipe out a percentage of the hard work that you've done. And this I'm giving away for free because it's what I believe. I like to call myself a pattern or trend trader. I believe that if you're on a position, and it works well with gold right now, where I'm bullish and it's moving up, if I'm in a trade, we raise the stop until it backs off. The trade we're in right now, well, we had to roll over from our April position to the next most active today. But we bought at 3,026 and it's, oh my God, it's at 3,071. And you got really strong leverage, which means you can make a lot of money with a smaller investment. But traders, hear me, let this sink in. You can lose a lot more money because that leverage works both ways. Never think that it only benefits you and that it doesn't throw any hindrances or obstacles that you don't have to deal with just because you're doing it this way. But I've always enjoyed futures because it's the pace and the quickness, and that leverage allows you to build huge capital or lose huge capital. Hopefully, you are able to sustain smaller losses as you learn your mistakes and move forward down the chain. And no charge on that one. But honestly, I really believe that trend trading, position trading, being able to hold on to a winning position as long as you can makes a lot more sense than even if I think that it's at 3071, that it's going to run out of steam at 85. And even if I'm 98% sure that I'll be right, why would I cap my upper level when I can trail the stop up? The worst that happens, or the majority of the time, I don't make as much money as I would make if I pick that top. But when it averages out, I'm able to deliver reasonable profits and keep that risk reward in line. That's the most important thing that young traders need to understand. Is it's the most important techniques you want to learn is controlling the risk. Because I meant this not as a joke. It is easy to make money in futures. It is so difficult to hold on to it.
Yeah. Well said, Gary. Thank you so much for that. Really appreciate it. We'll have to get you back on soon. Thank you so much. And to everybody else, thank you so much for tuning in here to the Soar. I almost said the gold forecast. You got me there, Gary.
Yeah, you can say that.
Thank you so much for tuning into Soar Financially. If you enjoyed the conversation, the masterclass that Gary just provided you with, put it down in the comments down below. We do want to hear from you. Leave a like and, of course, subscribe to our channel. It's tremendously appreciated, and it's a free way to support us. Thank you so much for tuning in. We'll be back with lots more. Take care.